When economists talk about the size of an economy, one number appears again and again: GDP. Now, GDP stands for Gross Domestic Product, and it's one of the most widely used measures of economic activity in the world. GDP measures the total value of all final goods and services produced within a country over a specific period of time. Usually, this is measured over a year or a quarter. So, in simple terms, GDP tells us how much an economy produces. If GDP is rising, the economy is growing. If GDP is falling, economic activity is shrinking. Economists calculate GDP in several ways. One of the most common is called the expenditure approach. This measures GDP by adding together four types of spending, which are consumption, investment, government spending, and net exports. Consumption is spending by households on goods and services. Investment is spending by businesses on capital goods like machinery, equipment, and buildings. Government spending includes public services such as healthcare, infrastructure, and education. And net exports represents exports minus imports. Exports are goods sold to other countries, while imports are goods purchased from abroad. Economists also distinguish between nominal GDP and real GDP. Nominal GDP measures output using current prices. Real GDP adjusts for inflation, allowing economists to see whether production itself has actually increased. GDP is extremely useful for measuring economic activity, but it also has limitations. It does not show how income is distributed across society, and it does not directly measure well-being or quality of life. So while GDP is an important indicator, it is only one way of understanding economic performance. So let's quickly recap. GDP stands for Gross Domestic Product. It measures the total value of goods and services produced in an economy. Economists often calculate it using the expenditure approach: consumption, investment, government spending, and net exports. And they distinguish between nominal GDP and real GDP to account for inflation. Understanding GDP helps economists track economic growth and compare different economies.